In this, the third video of the series Introduction to Managerial Accounting, we are concerned now with learning objectives 5 and 6. That is, we're going to continue explaining the difference between a merchandising and a manufacturing income statement, and we indicate how the cost of goods manufactured is determined and how we produce the report called the cost of goods manufacturing. In the last video, I drew a factory and I indicated to you and demonstrated for you the difference between a product cost and a period cost. Now to review, a product cost are all those costs that are part of producing a product. They can be categorized as direct material, direct labor, manufacturing overhead. These costs are not expenses in the income statement as you normally would expect, but these are costs of producing my inventory, so they are part of the asset called inventory. Now, to produce, for example, our desk, that's my product. We have the three cost categories. These costs are produce the finished goods, that is, the good that would be sold to the customer, the desk. And only when they are sold do they become an expense called the cost of goods sold. Until that time, till sales, they are not an expense. Period costs, on the other hand, are expenses of the accounting period. These are costs that are charged to the period in which they incurred, 2012. These are all non-manufacturing costs, and they can be in two categories: selling, marketing, and administration, which is delivering the product, and the general administration of a business. So there's your difference between a product and a period cost. Again, all costs in a company, a manufacturing company, can be classified into two categories: product or period. You must know this distinction. Product costs are further classified as whether they're direct materials, direct labor, or indirect costs, all categorized as manufacturing overhead. Period costs are expensed in the accounting period in which they're incurred, and that is selling and marketing and advertising and all other kind of general administration expenses. All of this was detailed in the last video. Now we are under, as we say, a periodic inventory system. We know exactly how much inventory we have in raw material, in work in process, and in finished goods. And we know the value of the inventory. Now these inventory is the cost of goods sold section, is that part of the income statement that details exactly what were the costs of the goods that were. Now the difference between a merchandiser, now a merchandiser, recall, is a company that does not manufacture its product, it buys it, it purchases it. So when you do their income statement for a merchandise company, like Carrefour, they know what their beginning inventory is at the beginning of the year. They know how much they purchased during the year. Together, that is the cost of goods available for sale. They subtract what is left at the end of the year, and that gives them the cost of goods sold. But now if we're talking about a manufacturing company, a company that manufactures, say, desks, well, their income statement looks very similar to a merchandise. There's beginning inventory, but this is the beginning inventory of finished desks that they have produced. Now they add to it all the costs to manufacture the desks during the year. This is called the cost of goods manufactured. And then they subtract the desks that they have left unsold at the end of the year, and that gives them the cost of goods sold. Well, now we have to determine what is the cost of goods manufactured. These are my product costs. And so we look, then on the income statement, you see it says the same thing. Here for a merchandise company, merchandise inventory at the beginning of the year, January 1st, 70,000. Add to it the cost of goods purchased throughout the year. They know what the invoices were for everything they purchased. Together, that gives them the cost of goods available for sale. We subtract the ending inventory, gives me the cost of goods sold. For a manufacturer, though, the cost of goods sold starts with the beginning finished goods inventory for the year. Add to it the cost of goods manufactured. Now this is a new financial statement which we will discuss shortly. Together then, that gives us the cost of goods available for sale. We subtract the ending inventory, and that gives us the cost of goods sold. Well now, how do I determine what this cost of goods manufacturing statement is all about? Well, conceptually, what we do is we say, look, we have three inventories: work in process, raw material, work in process, and finished goods. So we know what the beginning work in process was. That is, at the end of last year, when I stopped production, the value of the half-completed desks I had on the shop floor become the beginning work in process for the next year. During the year, we keep track of all manufacturing costs: direct material, direct labor, and manufacturing overhead. And these two together gives me the total amount of the goods that were worked in the process, the total amount of the desks that were on the factory floor for the whole year, the total value of them. And that gives me the total cost of the work in process. Then I subtract what's left at the end of the year not completed, and that gives me the cost of goods sold. So conceptually, that's how it is. Beginning inventory plus total manufacturing cost minus work in process ending inventory gives me the cost of goods. On a financial statement then, this is a new financial statement. But look, it's organized. There are three sections. Here's your beginning inventory of the work in process at the beginning of the year. And this is the ending inventory at the end of the year. Now, what happened during the year? Well, here are your three costs: direct materials, direct labor, and manufacturing overhead. So we have beginning work in process. During the year now, we kept track of how much material was used. And how we figured that is, we say, okay, we knew how much raw materials were at the beginning of the year, we know how much we purchased, therefore we know how much we had in storage. And people then pulled the material from storage, the wood, the laminate, and began to produce. At the end of the year, we know we had $22,800 left, unused, so therefore we must have used $146,400 worth of wood, laminate, and steel, and glue. No, I'm sorry, that's direct material, so it would be work, laminate, and steel. We know from the cards, the time cards of employees, just how much the direct labor was of everybody who worked on that desk. And we also know what the indirect materials were, we knew what the indirect labor were, factory repairs, utilities, all these costs which were necessary to produce my product. And they total $54,800. So therefore, I started off with $18,400. I added direct material, direct labor, and overhead. So the total manufacturing costs are $376,800. That's this plus this plus this. Now I add that to $18,400, and I get $395,200. And I count the ending work in process at the end of the year. That is the uncompleted desks. And if I was working on $395,200 worth of desks, and I have $25,200 worth of uncompleted desks, the value of what I completed would be $370,000. So this is a cost of goods manufacturing statement. The three cost categories: direct material, direct labor, and third, overhead. Add the beginning work in process, subtract the ending work in process, and you get the cost of goods manufactured. Now you carry that over, and when we look at the balance sheet for a merchandise company, recall they only have one type of inventory, and that's called merchandise inventory. We learned that in financial accounting. And the value is what they paid for it, $400,000. But for a manufacturer, recall my drawing of a manufacturing plant. You have three types of inventory. One, raw material. Two, work in process. And three, of course, the finished goods. So the raw material is the wood and the laminate and the steel. The work in process is the value of that material that I have bent and drilled and cut and everything else. It's no longer raw material, but it's not finished goods. And the final product, which is a produced desk, is finished goods. So now I have three different types of inventory, and that's how I present them on the balance sheet. And that concludes the introduction to managerial accounting. We talked about the difference between a financial accounting and managerial course. Management accounting is all about information that management needs. We only have one part of this course that has to deal with financial statements because we introduce the accounting for a manufacturing company. In your financial accounting course, you took accounting for a company that was a service company. Then we looked at accounting for a merchandise company. Now we're looking at accounting for a manufacturing company.